Hey everyone, welcome to this week's stock and macro update. So this week, I'm not going to go over any of the companies in our disruptors index like I usually do, and that's because there's so much other stuff to go into. There's a lot happening right now in the global financial system that I want to get to. So I'm going to start this week with the performance update, take a look at our index versus the broad market indices for stocks in general. And then take a look at what's going on in the UK with their pension market and with bonds there, what they're doing, and what I believe the Fed is going to do as a response. And then I want to wrap it up with what I see going forward with our type of stocks. So performance update real quick. The Disruptors Index over the past week was up 2.58%. And this is during a week while the S&P and NASDAQ were actually slightly negative. The S&P 500 down 0.37%. NASDAQ down 0.72%. The Russell 2000, which is a lot of small caps and a lot of growth, up 1.25%. And ARKK, which I see as like a growth stock index, up 0.19%. Performers in the Disruptors Index, top three were Energy Fuels, ticker is UUUU, up 16.28%. That's one of our uranium plays. And it was actually the worst performer the prior week, so making up some of those losses there. Number two, Guardant Health, once again near the top of the list, and that was up about 12%. And then third, Cameco Corp, which is our other uranium play. The ticker is CCJ, and that was up 8.78%. Bottom performers, Tesla was the worst performer during the week. The TSLA is the ticker, down 11.96%. Number two, Teladoc Health, TDOC, down 4.08%. And Uber, ticker is UBER, down 3.95%. So just a quick word on Tesla, because that had a rough day on Monday. Over the weekend, they had their AI day and their Q3 deliveries report. And it looks like this sell-off was a combination of things. So first of all, I guess the deliveries didn't meet the expectations of the market. That's definitely a possibility. They came in less than expected, but it was still 343,830 deliveries, which were 42.5% higher than Q3 of 2021. So still seeing massive growth in their vehicle deliveries overall. On top of that, they've already got over 908,000 deliveries for the year, which is almost more than they had in all of 2021. So this is going to be their first year with over 1 million deliveries. Last year, they hit close to 936,000. So in 3 quarters of this year, they're almost there. And Q4 is pretty much always the best quarter for them in terms of deliveries. So we might even see like 1.4 million deliveries this year for Tesla, which is pretty phenomenal growth considering that they've been able to sustain this growth now for like 5 or 6 years or more. The other possibility for the sell-off is just simple buy the rumor, sell the news stuff. So the AI day, obviously much anticipated, a pretty big deal. A lot of people knew about it. A lot of people probably bought thinking that something huge was going to happen during the AI day, and as a result, there were no buyers afterwards, and everybody sold their stock because of the lack of demand, because everybody already bought in beforehand. So this happens a lot during markets. Same thing, same idea as the Ethereum merge and a bunch of other stuff. So I wouldn't pay too much mind to the action on Monday. I mean, day-to-day stock movements are largely noise anyway. I don't see this as being a big signal or anything. And Tesla, obviously, as I just explained, is still seeing huge growth in their deliveries. And they report earnings 2 weeks from today. So definitely will be keeping an eye out for that to get more details on their growth. So now with the UK pension market and their whole debacle there. So like bonds across the world have been doing really, really bad this year because we're in a phase now of global monetary tightening where central banks across the world for pretty much every big economy except for China and Japan have been selling their government debt into the free market. The problem is that there are really not that many buyers for that debt out there because everybody's, usually the central bank of a company or a country is the main buyer for that country's government debt. In this case, they are all selling the debt on the open market, whereas they've gone from being the main buyer to the main seller, and there's no buyer to replace them. On top of that, they've been raising interest rates, And that's just another hit on the price of bonds, because when you raise interest rates, the price of the underlying asset goes down. There's a completely inverse relationship there. That's why things like QE and lowering rates are stimulative, because it pushes the price of bonds up and creates more overall confidence in the economy, creates more money and easier lending conditions, and just overall very, very positive economic things. And I want to get to why or what I'm seeing as the future for QE here. So as a result of this bond crash in the UK, pension funds, which is like a $1.6 trillion industry in the UK, and obviously that handles a lot of people's retirement money, those were in serious trouble. They were, they had hundreds of millions of dollars worth of margin calls, which essentially means that they were levered up on these bonds, which are seen as risk-free assets, and they're finding out the hard way that nothing is actually risk-free. So they, took, say, $50, and they were able to buy $100 to $150 worth of bonds with that $50. They borrowed the extra money to buy the bonds, so they were in over their heads with the amount of things that they bought. And when the price goes down and you lose the money that you put into it, and are starting to lose the money that you borrowed, you have to put more money into it so you don't lose your debt as well. And that's what happened to these pension funds in the UK. They got margin called. They didn't have the money to deposit to meet those margin calls. So now the Bank of England is actually once again doing QE. Instead of selling the UK bonds, which are also called gilts, they are buying the gilts once again. So pushing up prices on those, which lowers interest rates, which goes against everything that they're trying to do with quantitative tightening. So it's a pretty huge pivot now for the UK. What's interesting is the UK market is still expecting rate hikes. So if they're hiking during a period of QE, it's not going to be as effective. And another thing to watch is QE is actually stimulative, like I just explained, to an economy. So that is going to be, I think, a pretty bad decision to do during a time of inflation, which the UK is seeing some of the worst in Europe. So for energy and food, obviously both vital resources for everybody, they are in a bad situation with that. They are, I believe, the worst or the highest electricity prices of all the major economies in Europe belongs to the UK. Their electricity and energy inflation has been insane. Their food inflation is up to 13.1% year over year and climbing. That record high was just set in August, and I think the September data is coming out pretty soon, but probably still going to be very, very bad. So the food and energy prices in the UK are already very high, and they're growing very fast, and the central bank decides to do QE, which is stimulative to the economy, which means that prices are probably going to go up even faster going forward. And I guess the one thing that they're hoping saves this is the fact that it's so-called temporary. I think they said they're going to do QE for 14 days, and I guess hopefully it works out after that. But when central banks and just big organizations say temporary, they rarely mean it, and so we'll see what happens with the UK in that situation. But I think, QE, I don't think is a great idea right now, and it's the worst of two evils. So quantitative tightening obviously hurts an economy. It's designed to hurt an economy, and you do it when things are getting overheated, when inflation is rampant, or when there's overemployment and things like that. You want to do QT to kind of tone things down a little bit. And inflation is still high, and now there's this pivot, and I think it's really going to throw a wrench in things. This is what the U.S. did back in the 70s. They went into QE too early, and then we had a second wave of inflation later in the 70s, and that's when Volcker ended up raising the rates to 20%. So, we'll see what happens with the UK. As far as the US is concerned, I don't think that we're going to do QE. I know that that's been a hot topic recently, and I think that's the reason for this market bounce that we've seen. So right after the UK announced this QE, the market went up. So it was last Thursday, I believe. The market was actually up pretty big that day. Friday, it took it all back and more, set a new low, and then as of now, we've had two back-to-back days of very strong gains once again in the market. one thing to point out is that it's not only the stocks that are rallying, but also pretty much everything. Gold's rallying, oil's rallying, like gasoline, energy in general is rallying, and most commodities overall are up. So we're seeing, I think, the market trying to decide what's going to happen. It looks like QE narrative is the next thing up. But again, I don't think that the U.S. is going to take this route. First of all, it would hurt the central bank's credibility even more, even if they have anything left to salvage, which I'm not sure they do at this point. But for the sake of their credibility, they might not want to do that. And also, it would be interesting to see what their reasoning is. I guess it would take something as big or bigger as something like a pension market collapse. So don't get me wrong, that's a huge deal. And obviously you don't want people's retirement money to be in danger or lost. But considering, the inflation and what another round of QE could do to that, in the next 6 months or so, definitely is worth considering when these banks want to go back into QE. So I think it would take something huge in the market, like a pension meltdown or something equivalent to like the 2008 situation, in order for the central banks to have a justified reason to go back into QE, because that kind of size of an event could actually hurt the economy even more than the inflation would. And so you're going to have kind of a leveling off where the economy is hurt by some event, and that alone is enough to bring down the inflation because of the damage it causes. So then the Fed might have some room to do QE, but overall, I just don't see them doing that. So oil is up with the markets. I think that's kind of strange. I think that's the market saying that QE, that stocks are pricing in maybe the possibility of QE at this point. I just don't think it's going to happen. Another thing to point out is the demand for U.S. Treasuries is very low. So the Fed essentially went from the biggest buyer of Treasuries to one of the largest sellers. And September was the month that they were expected to ramp up their selling of their Treasuries up to, $95 million a month of assets in general, but most of those are going to be Treasuries. And now we're seeing the weakest parts of the global financial system start to crack with that UK pension market. A lot of the pension funds and big asset managers in the US as well are required to hold a certain amount of treasury bonds because they're seen as risk-free. So when you have all these players in the market, big institutions holding a ton of treasuries, they're very dependent on the treasury market remaining stable. So when you have a year like this, and I know as of the end of April, it was actually the worst year for treasuries since 1788, which might have been the first year that they were actually in circulation, which is kind of crazy. It's definitely an anomaly of a year we're having with that, and it's because rates were raised way too fast off of zero. So you had kind of an exponential increase in interest rates. That's resulted in a rapid, crazy, unusual decrease in the price of the underlying bond. And if the Federal Reserve continues this QT and sells the bonds into a market where there's really no buyers, and actually the largest holders are selling as well, Japan and China. So you took out the largest buyer, the Federal Reserve, you've got the largest holders selling, and you've got the former largest buyer, the Fed, is selling as well. There's not going to be anyone out there that can match the demand for these treasuries that are being sold, which is going to push the price down even more. So there is a possibility that we see something like a pension market collapse or something of that magnitude, in which case the Fed might do QE again. But barring that kind of situation, I think that inflation is too severe right now for the Fed to do that, and I don't think they're going to. And one of the reasons I think the inflation is still such a problem, and I know I've talked about deflation with things like retail goods, cars, the real estate market, commodities, but overall, energy is still a lot higher than it was a year ago. Food is not slowing down at all. That's kind of a sleeper. People aren't talking about that much, but food inflation here is pretty bad as well. The thing that really, I think, shocked people in August was the fact that discretionary goods were up so much in terms of inflation. That's the core CPI. So that's the things that that the Fed wants to crush demand for, and they can do that by tightening financial conditions, raising rates, quantitative tightening in general, which means selling treasuries, just making financial conditions worse, essentially creating a recession to crush demand, which is basically just like beating the economy with a hammer. And that's their method of doing this. And what they're going to affect the most by doing that is discretionary goods. But we saw the opposite of that in August. Despite their best efforts so far to crush the economy, people went out and bought discretionary goods because fuel prices had dropped so much. I guess people were more comfortable. It was kind of like a form of stimulus in a way. People had that savings on gasoline and energy in general, and certain aspects of food and certain retail goods, that they were comfortable going out and buying more, even though most of it was on credit card debt. So another thing to watch is, people are fine with continuing to go out and spend money, except savings are now so depleted from inflation that they're using credit cards in order to do that. And with higher rates, you're going to have higher payments on credit card debt going forward as well. So, the consumer landscape is still pretty much a huge mess. Again, people's savings are depleted, the lowest since March 2010. Credit card debt is now at an all-time high, and I think the credit card debt to savings ratio is like 1.7x or something. So for every $100 people have of savings, they've got $170 worth of credit card debt. So, credit card debt's going to expand at a faster rate because of rising rates, and that's going to hurt people in the mid to long term. And that eventually will absolutely drive down inflation. So if the Fed stopped raising rates, it would probably play out, and inflation would come down overall. I don't think they're going to do that, though, just because they seem to be looking at the backward indicators, the backward-looking indicators, like the employment market and like PCE and CPI and things like that, which are definitely lagging. So the employment market is still very strong. I know that today the JOLTS numbers came out, which is job openings, and those came down by about, I think, 1.1 million job openings were erased essentially in August. So the job market looks kind of iffy now. I wasn't expecting it to come down by 1 million jobs, but that could be a sign that the Fed might be closer to pivoting. So we'll see. The job market is still very strong. I know that there's still like 1.6 or 1.7 job openings for everybody looking for work. But as I said, I believe it was a couple weeks ago in the Substack, there are also a couple million people out there that are probably going to be returning to the job market here soon that could fill a lot of those positions too. At the same time, we could see companies start to remove job openings as well. So it all ties together really between the treasury market, the gilt market, consumer spending, and inflation. It all does tie together. So that's really my outlook on that. I don't think the Fed's going to pivot. It would either take something like the pension market breaking, something of that magnitude, or the jobs market getting a lot worse here in the next couple months, and inflation as well coming down. So what does that mean for our stocks? Well, I know I sound like a broken record at this point. I feel like I talk about this every week, but it's important to hold stocks that of companies that have a lot of cash, not a lot of debt, and steady incoming cash flows from their operations that they can be self-sustaining with. And that's because debt is going to be a lot harder to come by, as is cash. And these companies that are reliant on debt, especially reliant on debt to fund things like share buybacks and dividends, which are kind of frivolous spending in a way, especially right now, more so than the past 10 years or so. Those companies are going to be in trouble because lending conditions are definitely a lot worse than they were even a year ago, even 6 months ago. And as a result, they're just not going to be able to get the funding that they need to sustain this. So in the next few months, or at least, next 3 quarters or so, in quarterly earnings reports, we're going to hear a lot, I think, of companies saying that they're cutting share buybacks, they're cutting dividends, and they're liquidating part of the company, they're selling part to get cash to fund their operations overall. because the cash flow that they get isn't enough to do what they've been doing with all this extra spending. So companies that are able to actually sustain their business with their cash from operations are going to be seen as very, very valuable. This has already been seen a little bit, I think, because a lot of growth stocks, and that's another thing, real growth higher than inflation in terms of sales, are going to be seen as very valuable too. So growth stocks have a lot more going for them than people want to give them credit for. They've got a lot of cash. A lot of them barely have any debt. They've got growth that outpaces inflation. And they sell things in a lot of cases that people want and they want more of. So those are some things I think that are going to be drivers for growth stocks going forward. A lot of them haven't made new lows along with the indices this week, or last week. So that's another thing to take note of. A lot of growth stocks are still like 30% off their lows or even more than that, while the S&P just made a new low last Friday. So growth stocks, each quarter and with each announcement of something like a share buyback cancellation or a dividend cut, it just builds the case that much more for growth stocks. And I think we're going to see a huge switch. It's not going to be immediate, but over the next like 6 to 12 months, I think it's going to be pretty apparent that investor taste is changing and favoring these companies that are self-sufficient with their own cash flow, that don't have all the extra expenses to investors, and that have real growth, which means growth that exceeds inflation. So that is it for this week. I hope this was informative. So if you have any questions, definitely leave them below. I know I went over a lot, so more than happy to answer questions. And thank you so much for watching. I will see you Friday with this week's crypto update.